All right, so we're learning about receivables in much more detail than we had covered previously, right? So remember that we have to think about bad debt expense, right? That's a new concept that we're dealing with in this chapter. You have to estimate, if you do accrual-based accounting, which most companies do, if you follow GAAP, which most companies do, then you have to estimate your bad debt expense in the period that you earned your revenue. Because you really don't know how much you're going to collect from your customers and how much you're not going to collect, right? And so it could be that some of the customers you think are going to pay you, they actually never pay you. But since you don't know that, and you're not going to know it until the next period, you need to estimate your bad debt in this period so that you will be consistent with both with the expense recognition principle, right? Which says that you count your expenses related to your product in the same period as the revenue. So that's why we have to do that process of estimating bad debt. Okay, that was just your typical sale. We learned that if you accept a credit card payment, there are two ways to journalize it. One looks like this. And what you would do, actually, it's exactly like any other sale. It looks exactly like this normal sale. But the difference is the account receivable is for the credit card company because they're the ones that are going to send you the money. And then they'll collect from the customer, right? But also you have to debit the credit card expense. And that credit card expense reduces how much money you're going to get from the credit card company. So you don't actually pay that expense, you just don't get that money. But as I mentioned, there is a second way to journalize a credit card payment. Who remembers? What is the other way that's a little bit simpler, but not really recommended? What was that second method for journalizing a credit card sale? See if we have an example here. Yes, here's the example. You could just, instead of putting an account receivable for the credit card company, just consider it cash. But what was the problem with doing it that way?
If you never get the money, then you have to.
That's right. You didn't really get the cash, right? You're expecting to get the cash within a couple days, and as Julian said, if you don't get it, first of all, you're going to have to remember to go back in and adjust the transaction, right? And it's just going to be more work in the long run. So you might as well, in my opinion, do it that way. Makes it easier to track and make sure you got paid. Okay, then we went through lots and lots of examples. So it says here, bad debt negatively affects accounts receivable. I think we have where is it? Okay, no, it's later. So accounts receivable is the money that your customers owe you, right? Which would be gross. But if you subtract from that the bad debt, the difference is your net account receivable. So the more bad debt you think you're going to have, the less your net accounts receivable is going to be. Right? Because what you're saying is that bad debt, that's money we don't think we're going to get. So it reduces your net accounts receivable. It also reduces your net income. And why was that? Why does bad debt reduce your net income?
It's an expense.
It's an expense. Perfect. Exactly. The more expense you have, the less profit. So you can, as an accountant, use different methods of calculating your bad debt. And you get to choose which method you want. You can pick the one that makes you look more profitable. If your company is trying to attract investors or borrow money. You can pick the one that makes you look less profitable, so you pay less income tax. Ultimately, it would be best to pick the one that's the most accurate, but GAAP allows us some discretion in this area. What you cannot do is lie. You can't do things like inflate or deflate the value of your assets just to qualify for a loan, or you can't lie about your profits in order to pay less in taxes. You know, you can't do that. You have to be honest, but you can pick one of these methods. And if next year you want to switch to a different method, you can do that as well. Right? You probably don't want to change every year, but you are allowed to adjust your method. Now, for the most part, we don't use this direct write-off method. There was one exercise, I think it was, where it was used, but that was a rare case. In general, you can't wait until your customer doesn't pay you and then count it as a bad debt expense. That's not allowed under GAAP for the most part. Instead, what you have to do is estimate your bad debt and create this allowance for doubtful accounts. Kind of a funny name, right? And then you use that allowance for doubtful accounts to actually track how close your estimate was and how much your customers actually did not pay you. And then you can always adjust it next time. Now, when we do that, when we create that allowance for doubtful accounts, that's called the allowance method. And we've got three methods by which we can do that. You see one of them here, the aging method, where you take your accounts receivable and you break it into categories based on how old that debt is. And that, again, is the most accurate method. What were the two other methods besides the aging method that we could use?
So balance sheet.
Balance sheet and income statement. Perfect. Exactly. Now, the income statement method takes a piece of information off of the income statement and then you multiply that by a certain percentage. What was that line off of the income statement that we use in the income statement method?
Total credit sales.
Yep. Technically net credit sales, but yeah, your credit sales. And what about with the balance sheet method? What do we multiply the percentage by for using that method? Accounts receivable. Okay. All right. Isn't it nice that you all have a spokesperson here, Julian, representing everybody? Okay, so then when a specific customer doesn't pay you and you say, okay, we give up on that customer, then we go ahead, clear out their account receivable, and we think, trying to think debits or credits, we debit allowance for doubtful accounts in that case. Because initially we credited allowance for doubtful accounts. Every time a specific customer doesn't pay us, we debit the allowance. All right, so this is the journal entry when you estimate your bad debt. It's a debit to bad debt expense, credit to allowance for doubtful accounts, and that's why when a customer doesn't pay us, we then debit allowance for doubtful accounts. And if we had estimated perfectly how much bad debt we would have, then at the end of the period, our allowance for doubtful accounts would have a zero balance. Because we would have debited exactly the same amount as the credit that we started with. But that's usually not the case. You usually end up with either a debit balance or a credit balance in that account. All right, it is a contra asset account because it reduces the net accounts receivable, which is an asset. That was a slide I was looking for earlier. Already covered that. So now remember, this does get a little tricky, but if you can just remember when you're using the balance sheet method and there is what was it, a credit balance? Is that what it says up here? Yeah, credit balance, it's right there. When you're using the balance sheet method and there is a credit balance in allowance for doubtful accounts, you have to subtract that amount from your new estimate, and that is the amount you're going to credit to the allowance for doubtful accounts. If there is a debit balance, you add that debit balance to the new estimate, and then that is the amount that you credit to allowance for doubtful accounts. Okay? So if there's a credit balance, you subtract, debit balance, you add. And this only applies in the balance sheet method. Which, logically and speaking from memory, I think that would include the aging method, because the aging method is also based on accounts receivable. I don't think that that comes up in the problem set. But if there is one with the aging method and there is a previous balance and allowance for doubtful accounts, you would follow the same procedure. But if it's the income statement method, you don't need to worry about it. Okay, any questions on that or anything? Any questions at all? Right. Let's see. Oh yeah, this is when you do decide that a specific customer is just not going to pay you, then you go ahead. Yeah, that's right. You debit allowance for doubtful accounts and you credit their account receivable. I mentioned that earlier. But then if they pay you, you have to reverse that transaction and then you process their payment. And when we do that, we end up with both a debit and a credit to their account receivable, right? Which is kind of redundant, but it leaves a clear paper trail. All right, so a lot of this is just examples. We can skip past those. This was the aging method where, again, they've broken their accounts receivable down into categories. You get to pick how many categories you think are appropriate, what time period they should cover. And once you set up those categories, then you can just find out what's the total amount that your customers owe you in each of those categories. You could look back and see what percentage of customers tend to not pay you if they're in one of those categories. And then you can just multiply the amount times the percentage to get your estimated bad debt, add it all up, and that would be the bad debt estimate using the aging method. So, oh yeah. Yeah, so I was right. This is a case where there is the aging method that's being used, which again is a variant of the balance sheet method. And so in that case, the previous balance and allowance for doubtful accounts does matter. So it's only the income statement approach where you really don't care if there's a balance under allowance for doubtful accounts. Right, we did some more practice. Yeah, we talked about how the aging method is more accurate, but it is more time consuming. You don't have to use it, but if you're going for accuracy, which is generally a good idea in accounting, and you have the time, then the aging method would be best. Then we got into ratio analysis. We had the accounts receivable turnover ratio. Anybody remember the formula on that one? Net credit sales divided by your average accounts receivable, right? How do we figure out average accounts receivable? Okay, well, it was beginning accounts receivable plus ending accounts receivable divided by 2, right? And then We had number of days sales and receivables. That was an easy one. What was the formula for that? 365 divided by your accounts receivable turnover ratio. Yep. All right. So again, there is the AR turnover formula. And here's the formula to calculate average accounts receivable. So you want to do this one first before you can do that one. And that was the formula for number of days sales and receivables. Very good. We practiced that. That's pretty much, yep, that's it. That's as far as we got. All right, so questions on anything? Okay. So I talked about this already, but again, you are allowed to choose which bad debt estimate you use. That is called earnings management. Perfectly okay. It can make you look more profitable or less profitable. It's really just a temporary thing though, because maybe it makes you look more profitable this year, but less profitable next year. So it's not like you're really having a significant long-term impact. But what you're not allowed to do is earnings manipulation, where you ignore GAAP rules. As it says, you manipulate your earnings, that's fraud, right? So if you lie, you deceive your investors or anybody, any stakeholders, that's fraud. And we had a chapter, right, where we talked about fraud. So we understand that's not a good strategy, right? Especially if you get caught. All right. So I think this is just an example here. So that we see this company's net credit sales for 3 years. We see their accounts receivable for 3 years. I guess that would be the ending accounts receivable. And, or maybe it's average, doesn't really say. And this is their aging categories and percentages. So what are the effects if they change their percentages? Okay, there's a lot going on here, but it's actually pretty simple. If you change your percentage from 5% to 4%, you're going to end up with a lower estimate. You have less bad debt. Less bad debt makes you more profitable. It'll increase your income taxes. Now, why would you change the percentage? Well, really the only good reason to change the percentage you're using for your estimate is because you looked back again over the past year or 2 years and you realized that it's changed. More customers are paying you, so the percentage decreased. Same thing if you're, doesn't matter if you're using the balance sheet method or the income statement method. In both cases, they're saying the same thing. If the percentage goes down, you'll have less bad debt. If the percentage goes up, you'll have more bad debt. And the percentage is based on actual historical data. Okay, they took up a whole lot of space just to say that. And let's see. So here's the original distribution for their aging. They have these 3 categories: 0 to 30 days past due, 31 to 90, and more than 90 days past due. Down here, we see the same 3 categories. The only thing that changes here is the percentages. The amounts are the same. But again, they looked back. They said, you know what, we need to update these percentages. They looked at how many of their customers in each of those categories ended up paying and how many ended up not paying. And they came up with these new lower percentages. Great, more customers are paying us. And because the percentages are lower, the total uncollectible dropped by about $3,000. Meaning we have $3,000 less bad debt and we're $3,000 more profitable. Make sense? Okay. If we change from the income statement method to the balance sheet method, what will be the impact? Well, it depends. Because it's based on what is the percentage, it's based on what is our net credit sales, what is our accounts receivable. So it's not always going to work out this way, but in this case, it went from 280,000 estimated, net income to a higher net income, almost $10,000 higher. And why? Because the bad debt expense went down by about 10,000. So if what they're going for is more net income, then they should probably use the balance sheet method, at least for this year. Okay, this will be a good exercise here for you to practice, not actually an exercise from the exercise set, but this will be good practice. Okay, so you're an investor and you're thinking of investing in either company A or company B. We see their beginning and ending accounts receivable. We see their net credit sales. What you need to do is calculate the AR turnover ratio for each. Calculate number of days sales and receivables. And then think about which company you would invest in. Okay? So the first thing you have to do is figure out the average accounts receivable. In this case, they're nice round numbers. If we look at company A, beginning and ending, what is the average here? $50,000 plus 80,000 divided by 2, what do we get? 65,000? Exactly. And how about company B? An average out 60,000 and 90,000, what do we get? 75,000. Excellent. So we already know, use calculator, but might be able to do that in your head. And you can see we have average accounts receivable of 65,000 for company A, 75,000 for company B. So now we're going to take net credit sales, divide it by that company's average accounts receivable. That'll give us AR turnover ratio. We're going to take each of those ratios, divide them into 365. So in other words, 365 divided by the ratio to get number of days sales. So go ahead and do those calculations and then tell me which of these companies, if everything else were equal, which one would you invest in? A or B? Okay, so it takes a couple minutes. Feel free to work together. Who has an answer for company A? Well, let's do it together. So what do we do? How do we calculate company A's AR turnover ratio? Okay, so we have their average accounts receivable of 65,000. And then what do we do next? Sorry, what was that?
After you get the answer, adding both and divided by 2, don't you divide it by 550,000?
Well, we divide 550,000, the net credit sales, by the average accounts receivable. So we take net credit sales divided by the 65,000 that Susanna pointed out, and 8.46. Did I do that right? Is that what you all got? Okay. Okay, so we'll just put that's company A. Okay, and then the same thing for company B. So we're going to take 460,000 net credit sales we divide it by the 75,000 AR turnover ratio we talked about earlier. 6.13, right? Okay, and then what do I do again for number of days sales and receivables? This is the easy one. Take 365 divided by the AR turnover ratio. So for A, we get 40, we'll just call it 43 days. Save a little space here. And then for B, again, we take 365, divide by the AR turnover ratio. We'll call that 60 days. And I think I mentioned on Monday, I'm sure I must have mentioned, that as your AR turnover ratio goes up, which is good, that's going to make your number of days sales go down, which is also good. But if your AR turnover ratio goes down, it's bad. That makes your number of days sales go up, which is bad. So when we look at this, we see clearly company A has the better AR turnover ratio because it's higher, and they have the better number of days sales and receivables because it's lower. So as an investor, everything else was equal between the two companies. Just looking at this, we would go with company A because they're in a better financial position. The ratio of how much accounts receivable to net credit sales is a bigger ratio. I mean, not only do they have higher net credit sales, but they actually have lower accounts receivable. So God bless you. They're doing a better job of collecting the money that their customers owe them. And they're doing it faster in 43 days as opposed to 60. Okay, does that all make sense? Any questions? Okay, let's go to this next concept. Move back over here. So these are all different sorts of long-term scenarios where it changes when we count revenue and when we count when the expenses might occur. So there are 4 of them that are listed here. What if we have a long-term construction project, like the nursing building down here? That took years to get built. I remember when I first started working here, I used to park over there. And it was nice and close to this building. And now you can't park there anymore because there's a building in the way. There's no more parking lot on that corner. But you know, it takes years to get the permits, to get the design, to hire the contractors, and then to lay the foundation, build the building. You have to do the outside, and then you have to make sure it's all, the internal part is all done correctly. So in that case, the company that's doing the construction, when can they count that revenue? Under normal rules, they'd have to wait till the whole building was done to be able to say, we made a sale. And that doesn't seem right, right? Because that could be years. So that's a case where you base the revenue on certain milestones. So you might say, okay, when we lay the foundation, that's the first milestone. We're going to count 15% of the revenue at that point. And then when we put up the walls, that's going to be another 20% of the revenue. And so on and so on. So at certain milestones, you're allowed to then count that as part of the revenue. Another long-term scenario would be if there's a real estate sale that's an installment sale. And what that means, as it says here, is there's not going to be any payment made until the following year. Well, a sale has been made, right? But no payment has been received. So as it says here, you would use a gross profit percentage every time the buyer makes a payment to the seller. And so you're basically dividing the revenue up as you receive payments. That becomes when you can declare the revenue. Magazine subscription fees. You subscribe to a magazine. Let's say it's a monthly magazine. They don't send you the entire year's worth of magazines at once, right? They send you one a month. So they can only count the revenue every month. Every time they send you a magazine, they count it as a little more revenue. And what if you sell some equipment and you agree to service that equipment? Well, the equipment you can count as a sale right away. But the service portion, you have to spread that revenue out over time. So if you're going to be providing that service for a year, then you would spread that revenue out probably monthly over the course of that year, kind of like the magazine subscription. So these are unusual, circumstances that do allow for different ways that we can count the revenue. Questions about any of these 4 examples? Right. Well, let's go into another concept. Notes receivable. We've talked about these in the past. A note is what? What do we mean by notes?
Loan.
The loan. So it could be we actually made a loan to somebody. That's what banks do, right? That's a big part of how they make their money is they issue loans. Those loans are called notes. Even the currency, the bills, that we use, dollars, $5, $10, those are also called notes. Because basically they represent money or value that the federal government will back up. Right? You could go to any bank and say, I'd like to deposit this note, and they recognize that this is value that the federal government vouches for. There was a time when there were different currencies used in different parts of the United States way back when. It's kind of crazy to think about. You go from one state to another or one colony to another, and they're using a different currency. But anyways, so a note is just some sort of a loan. And it can also include a situation, in fact, it's probably more common for most businesses, where you make a sale to a customer and they don't want to pay you at that time. But you say, okay, you can pay us later, but we're going to charge you interest. You didn't actually loan them money, but you let them buy the product without paying you. Because it's a note, they're going to sign the document indicating they know when they have to pay it back, they know how much interest rate you're going to charge, they understand the credit terms. All of that is specified in the note. They sign it, you sign it, and then you're allowed to charge some interest. So these are the elements of a note. The principal is the original amount that's owed, right? Whether it was a loan or a sale, it's how much the person is agreeing to pay, not counting the interest. There's the date of the note. You need to know what date it takes effect, so that you can figure out the maturity date, the date that it has to be paid back by. So if it's a 2-year note starting today, well, what is today? The 20th of March? So a note taken out today, that's a 2-year note, would mature March 20th, 2026. Right, so you have to know the issue date so you can figure out the maturity date. And then again, we can charge interest at a specific interest rate. It used to be when you bought things on credit, anytime there was an interest rate involved, some companies would get really tricky and they would tell you an interest rate that wasn't the annual percentage rate. It was something else. So they would throw out these other interest rates to make it look like you were getting a better deal. And that caused a lot of confusion to consumers. Sometimes they get the bill and say, wait a minute, I'm getting charged more interest than I expected. I thought he said it was a 4% rate and it's a 12% rate. What's going on? Then you would go back to the store and they would say, oh, well, that's this monthly amortized rate or something. You're like, what is that? So it's now required that when there is an interest rate, you always have to specify the APR. That's standardized. If the lender is throwing out any other type of interest rate, you don't hear the letters APR, ask them what the APR is. Because then you'll know what is your annual percentage rate that you're going to be paying. None of the other rates really matter, right? Ask for the APR. And that's what we'll be talking about here, annual percentage rates. So just to compare accounts receivable and notes, accounts receivable, you don't need any formal document. Basically, the seller just says, sure, you can pay us later, we'll send you an invoice. Accounts receivable are always expected to be paid off within a pretty short period of time. You remember we saw credit terms like 210 net 30, right? So it was due within 30 days. Or you might see examples in this chapter up to like net 150, that would be 5 months. You never see accounts receivable due in longer than a year. Because that's a long time to wait, right? If you're gonna wait that long to get paid, you're gonna wanna start charging some interest. So then you would issue a note. Now notes can be short-term. They don't have to be long-term. But they do include interest. And they are formal. They do require signatures by both parties with explicit terms. So there won't be any confusion about when the payments are due, when the loan matures, everything's specified in writing. All right, so here we have a sale where instead of paying, the customer signed a note. See, it's a pretty simple journal entry. Instead of an account receivable, it's a note receivable. Or if it was an actual loan of money, the lender is paying out cash, so cash is getting debited, and they've issued a note, meaning they expect to get that money back sometime. Right? They'll receive that money in the future. So pretty simple journal entries. Okay. And then to calculate how much interest has accrued, it's a pretty simple formula. You take the principal, the amount that the customer owes, times the interest rate. Notice it's an annual interest rate. And then times the period of time that we're actually covering. So if it's a year, it would be just times 1. So you could just skip that step. So if you want to know the interest for a year, you can just take the principal times the interest rate. You got it. But if it's for anything shorter or longer than a year, then what you would do, take the principal times the annual interest rate times the number of months you're charging interest for divided by 12. Okay? That will work for any period of time. in this scenario, the principal's $2,000, the interest rate is 10%. And it's for 1 year, so they really didn't have to do the times 12 divided by 12, right? That's just like multiplying by 1. They could have skipped that. And they could have just said 2,000 times 10%, that's $200 of interest. Now let's look at the journal entry here. They credit interest revenue because they've earned it. The lender made the loan. Time has gone by, the year has gone by, and they've earned 1 year worth of interest. So it's revenue. Sometimes you'll see interest income. It's just a variation, means the same thing. Interest income or interest revenue are the same. Now, in this case, did the customer pay that interest payment yet? What do you think? Based on this journal entry, do you think the customer paid yet? It didn't. Right, because it says interest received. If they paid us, we could just debit cash, but they didn't. So we've earned the interest revenue, and we're expecting to receive that money sometime from the customer. All right, so here we have something. Oh, on the due date. Okay. Okay, yeah, so here, this is when the customer is actually making the payment. So they're gonna have to pay back that original $2,000 principal, the amount that they borrowed or the amount that they owe us for the merchandise, right? And then they're also gonna have to pay the interest. Now, remember that first year's worth of interest, right? That the customer didn't pay. So we said it's receivable. Well, after another year goes by, we're going to apply a second year worth of interest. And we're not compounding or doing anything complicated. We're just using simple interest. So we're just taking that principal times the interest rate, and that's how much they owe for year 2. And they still owe us for year 1. So when they pay us $400, it's covering year 1's interest receivable and year 2's interest revenue that we just recorded. And they're paying the principal. So they're paying us $2,400 in cash. And we could simplify that journal entry like this, where we just put the whole $2,400 in cash that we got, the $2,000 principal they paid off, the $200 interest receivable from last year that they're now paying off, and then the $200 of interest for this year. And it's done. Now they've paid off the entire amount that they borrowed plus 2 years worth of interest. Okay. Any questions on these journal entries? Any questions on notes receivable? What if they don't pay? Okay, I think we saw one of these on Monday. So they didn't pay. So what we're going to do is we're going to clear their note receivable off the books. We're going to clear the interest revenue off the books. I guess we're only counting 1 year of interest. I don't know why. I would do 2 years of interest, but anyways. And then we're converting that all to an account receivable. Oh, I know why, because they already have an interest receivable. So now they have an account receivable and an interest receivable. But yeah, still I might combine them with just one account. Anyways, doesn't really matter. What we're doing is getting rid of their note and now saying they have an account receivable. And the reason we're doing that is because the loans matured. We're not going to charge any more interest on it because we had only agreed to charge the interest for the 2 years. And now we're saying it's all due, and it's due now. And this lets our account receivable department know, go after this money. Try to get this customer to pay. don't show up at their house and beat them up, but do whatever you can within reason to get them to pay. And then if they don't, then you can send it to collections or sue them or whatever you want to do. So then we've done that exercise already. See what's next. Okay. So here's a case. This is the other way. Because on that last one, we were converting a note into an account receivable. In some cases, you might convert an account receivable into a note. That's what's happening here. So there was a customer that owed us some money. It was an account receivable. They didn't pay us. We contacted them and they said, well, we can send you $250 right now, but you're gonna have to wait for the rest of it. So we said, okay, we'd like for you to sign a note and we'll start charging you interest. The customer said, okay. So now they've paid us $250. They've signed a note for $750 and we clear off their account receivable. They don't end up paying the note by whatever maturity date we established. We might convert it back to an account receivable and then we more aggressively try to collect from them. You can turn an account receivable into a note. You can also turn a note into an account receivable. All right. If we do sell it to a collection agency, that's called factoring. I think we saw an example like this on, maybe I'm getting my classes mixed up. Did we talk about factoring on Monday? Okay, that must have been my online class. So in this case, we've given up on collecting this $2,200. Person's just not going to pay us. Well, that means we don't get the money. But if there is a company out there that will buy this debt from us, at least we're getting something, right? Better than nothing. So if we find this collection agency that says, yes, we'll give you, we'll give you $500. Great, we'll take it. And then they'll go and try to collect the $2,200. They'll probably add some fees, some collection fees on top of it and late charges and things. They have ways to try to increase how much money they can collect. And these collection agencies, they can be pretty darn aggressive. Even illegal sometimes. They sometimes overstep the bounds. They lie to customers and tell them they owe money they don't actually owe and things like that, in some cases. But anyways, that's not our problem because we sold off the bad debt to them and then we have no control over what the collection agency does. So in this case, we wiped the $2,200 off of our books. As far as we're concerned, customer doesn't need to pay us that. And we get the $500 from the collection agency. The rest, the $1,700 that we are never going to collect, we just count that now as a factoring expense. Doing that then decreases our profits, right? Because expenses decrease our profits. And also decrease our tax liability. Income tax, specifically. So that is an option, factoring. But usually it's pretty, you get very little, bang for your buck by doing that. You get pennies on the dollar. All right, questions or comments? Right. Oh yeah, so here's a situation where we issue notes receivable with an interest rate of 10%, maturity of 18 months for every sale, and there's a minimum $500,000 for each note. That would be a nice business to have, right? Because for every $500,000 note at 10% interest, you're earning $50,000 a year. And because they're for 18 months, That comes out to $75,000 for each of these notes that you're earning just in interest. However, one of our clients is not able to pay within the 18 months. They contact us, they want to renegotiate the terms. So let's think about this. We sold them something, health food. We sold them $500,000 of health food 18 months ago. We've already earned $75,000 of interest. But now they owe us $575,000 and they say they can't pay us. What should we do? Should we renegotiate the terms? Give them more time? What other options do we have? We do renegotiate the terms and say, okay, we'll give you another 6 months. And now we're going to start charging you 20%, right? We could do that. They agree to it, great. We would earn another, whatever it comes out to. We would earn more money. But what else could we do? Other than renegotiating the terms, what options do we have? Factoring, okay. You could say, sorry, we're not going to renegotiate with you. You owe us the money. By the way, we've sold the debt to this other company, so actually you can pay them. They already gave us money, so you deal with them. And then if the customer tried to pay us, it'd be like, too late. You have to talk to them. That would be one option. Other than factoring, what else do we do? Think like a business person. Pretend like you're Donald Trump for a minute. Not that he's the ideal business person, but he's definitely a business person. What would Trump do? Sue, perhaps? Probably. And we could do that. We had a deal. Customer violated their terms of the deal. We could sue them. Of course, that means we need attorneys. It could take years. It could cost a lot of money, but we could sue them. Anything else we could do? We have our own internal collections department. You can tell them, go after this guy. Call him every day. Send them letters telling them we're threatening to sue. Intimidate the guy, within reason. We could try that. Can't really think of too many other options. Renegotiate, factor, sue, collections, report it on their credit. That's not really going to help us, just kind of vindictive. Probably about it.
Can't you also ask for part of the company?
Like for part of their company?
Yeah.
Okay, yeah. That'd be interesting. Say, okay, you don't have the cash, give us stock in your company. Maybe. But if they're having financial trouble, you really want stock in their company. Maybe, maybe in some cases you do. You get enough stock and you can take control of the company, maybe you can turn things around. Interesting idea.
Buy it, gut it, and sell it.
Yeah, buy it, gut it, sell it, yeah. All right. Okay, so here's a comprehensive example of bad debt. All right, so we've got this customer that we've got this company that allows customers to pay with an in-house account. What did I tell you on Monday we do if it's an in-house account? What do we treat that like? Remember?
Account receivable.
Account receivable, exactly. All right, and we have to estimate bad debt by either the income statement method, the balance sheet method, or the aging method. There is currently zero balance in allowance for doubtful accounts. Good, that makes it easy. This is their credit sales, our credit sales, I should say, our accounts receivable. This is our aging. So if we estimate bad debt with the income statement method, we take credit sales times whatever percentage, right? And then the journal entry looks like this. It's a debit to bad debt expense. It's a credit to allowance for doubtful accounts. If we use the balance sheet method, same thing. It's just that we're taking accounts receivable times a percentage. But the journal entry is the same, right? It's also debit to bad debt expense, credit to allowance for doubtful accounts. If we're using the aging method, we total up how much we think is uncollectible in each of these categories. And again, the journal entry looks the same. Just the amount would be different. And what does this say? Oh, this is just comparing the three options. So in this case, it came out, the aging method gave us the lowest, and the income statement method gave us the highest bad debt, right? That's just the way this example came out. We haven't done exercise 15 yet, but I think we got up to 13, so we're almost at 15 anyways. Let's go ahead and summarize this chapter, and then we'll get to the exercise set, okay? All right, so revenue recognition principle, we know it tells us we can only count revenue when we provided the product or service. There are some exceptions when we're dealing with longer term products or situations, but in most cases, that's the way it works. When you provide the product or service, you can count the revenue. And then the expenses related to that product or service have to be in the same period, which is why we have to estimate our bad debt for the sales that were in that period. We can issue accounts receivables to customers, allowing them to pay us in a period that's less than a year, or technically it could be less than an operating cycle. And when we estimate the bad debt, it's an expense. We generally do not use the direct write-off method because that would not be GAAP compliant except in rare circumstances. Instead, what we do is we use either the net credit sales, which would be the income statement method, the accounts receivable, which is the balance sheet method, or aging of accounts receivable, which is the aging method, to estimate the bad debt. And then we track and see how close we were, right? We can calculate our AR turnover ratio by dividing our net credit sales by the average accounts receivable. We can then just take that AR turnover ratio, divide it into 365 to get our number of days sales and receivables. We want the AR turnover ratio number to be high and number of days sales to be low. We are allowed to choose which of these methods we use to estimate our bad debt. That's called earnings management. Already mentioned there are some long-term exceptions to how we recognize revenue. Already talked about accounts receivable. I'll add that there is no signed agreement in AR and an accounts receivable arrangement. It's just an invoice, and there's no interest involved. However, when there is a note, there is a signed agreement, and there's interest. The way you calculate the interest is the principal that's owed times the annual interest rate times the number of months you're calculating interest for divided by 12. There we go. It's done with accounts receivables chapter. And any questions or comments? right then.